Okay, so now we're going to look at, in this next video on Chapter 4, we're going to begin by looking at the taxation of mutual fund income and a little later on exchange-traded fund income. The IRS does not tax mutual fund income if the fund is diversified. It's not a focused fund on just a handful of stocks. Their thinking is, in that case, this is just a way around taxes. But if it's a diversified fund, the fund does not pay income tax, and the income has to be distributed. So we're talking about the dividend income of the securities the fund holds has to be distributed to the investors, and they then pay taxes on the on the dividends. And also, when the mutual fund sells at gains or losses, those capital gains and losses are also distributed to the investor, and they pay taxes on the capital gains and on the dividend distributions. Another term you need to know is mutual fund turnover, and that is the ratio of trading activity to the assets in the portfolio. So if this was a fund that had $100 million worth of assets and they sold $1 million worth of those during the year, then they have a 1% turnover, 1 divided by the 100 million. So, and of course, portfolio turnover does in fact impact investor tax liability, because the more turnover there is, the more capital gains there are. If there was no turnover, there would be no capital gains. So astute mutual fund investors look at turnover and prefer funds that have a lower turnover ratio. Another issue is that the more turnover there is, the more brokerage fees, commissions that the fund pays to a brokerage company for those transactions. And that goes against NAV and impacts the annual return because of those commission costs. Now we're going to look at exchange-traded funds. This is one of my personal favorites. The text says they're offshoots of mutual funds. I guess they are, or at least the mutual funds preceded them. And in my view, exchange-traded funds are a new and improved version of mutual funds. For one thing, they are traded and priced throughout the day, whereas mutual funds are only priced at the market close once a day. So you can see more dynamic pricing on exchange-traded funds. They say potentially lower tax rates. They definitely have lower rates because the structure of exchange-traded funds was designed to avoid capital gains. So the trading within an exchange-traded fund does not trigger distribution of capital gains to the investors, which lowers their tax bill. So that's a wonderful thing. It says they're lower costs. They typically are lower costs than mutual funds, although not necessarily. Exchange-traded funds were introduced with index funds that were passive. There was not any active management. There was no manager making buy-sell decisions. It was all really algorithmic. That there was, a plan, investment policy developed, and they adhered to that strictly. And large funds, it's driven by computer, the buys and sells, so that keeps the cost down when you don't have a management team or an investment advisor. So the investment policy is developed when a fund is first constructed, an exchange-traded fund, and they stick with that investment policy. So, that's they say a disadvantage is brokerage commissions. Well, you've got loads on mutual funds, so to me that's kind of a wash between ETFs, exchange-traded funds, and mutual funds. You can see that I'm not the only one that thinks these are wonderful little developments. that since around 2009, 2010, the growth of ETFs has been very steep. They have outgrown mutual funds by quite a lot, I believe. So a lot of investors are discovering them, and they have them for some time now, and they've become very popular. However, still, exchange-traded funds are still, or ETFs, they're known by, pretty small percentage of the market as of 2017 of the total investment company assets under management. And the mutual funds, still much larger piece of the pie. I'm sure this has changed significantly since 2017 because ETFs are growing so quickly. And you can see too, closed-end funds and unit investment trusts make up just a tiny slice of the pie. So you really want to know about mutual funds, the facts around mutual funds and ETFs. That's really where the action is. Now, this chart illustrates an issue for mutual funds, for actively managed funds, that's been going on for some time, that these professional managers of these funds cannot seem to beat an index. This is what gave rise to ETFs. Now, bear in mind, you cannot invest directly in an index. Okay, you can invest in a fund or an ETF that tracks an index, but your performance would be less than the index because of trading fees, if nothing else, commissions to buy and sell securities. So you would not expect returns to measure up to the index exactly, even if it's designed to track the index. But if you look at the differences here, returns on every year, let's move up to 2016. You can see in almost every case, the indexes outperform actively managed funds where there's professionals involved. So that's kind of damning on active management. And again, gave rise to passive management, just development of an ETF that seeks to track an index and saves the cost of managers at the controls. This chart shows some historical research on how mutual funds that have performed well, how they do in successive periods. Many investors look at how a mutual fund or a stock has done in the past few years and expect it to continue. If it's outperformed, they expect it to continue to, and this is a flawed assumption. With mutual funds, which are managed by professionals typically, in the 70s, if we take funds that measured in the top half of all mutual funds, 65% of them stayed in the top half in later periods. But when you move to the 1980s, only 51% of top half performers stayed in the top half, about half. And about 48, also about half, moved to the about half of the top half moved to the bottom half. If that's not confusing enough. So the bottom line is this study, as well as others, one done by the Wall Street Journal, has shown that top performing mutual funds are no more likely to outperform in the future than any other mutual fund. So looking at past performance truly is no indication of future performance. In fact, Morningstar ranks funds by giving them stars, 1 to 5 stars. And the Wall Street Journal found that 5-star funds, the top performing funds, were more likely to fall to a 1-star status than to stay in the top tier. So past performance is just not a good indicator. We need to look at other indicators besides past performance to get an idea of what we should be investing in. So here's a list of sources to get information on mutual funds. Morningstar is kind of the gold standard for mutual fund information. You can get a fund prospectus on a particular fund. Yahoo or finance.yahoo.com is a great source. The Wall Street Journal's personal favorite of mine. I think the best publication there is in the world, particularly in finance. It's just really well done. The American Association, I think it's called the American Association, maybe it's American Institute of Individual Investors. At any rate, one or the other, it is also a very good source for information on mutual funds. So no shortage of places to go. You have Google and know how to use it, and the information out there is virtually unlimited. So we're going to stop here. There's some appendix items further on in the slide deck, but we're going to knock it off here. And thank you for joining me for Chapter 4. I want to remind you, I'm trying to create a pattern here, and in the hopes that you'll remember that if you want to accumulate wealth, you've got to spend below your means. And if you'll do that, you'll be saving money and have funds to invest, to grow and build your financial capacity. So that when you're no longer able to work, you've got some means of avoiding poverty. So until next time, guys, be safe, and I'll see you at the next video.